So here's our peak in 1980. As you can see here, we had a breakout, a little bit of an up move. Then it kind of came back in and settled in, but held this line before a bigger up move came in. So if we go back to our current time frame and we flip over, what this would be is this is that same breakout. And again, like I said, I think it could extend itself a little bit, and then we could come back in and potentially find our way back down into this level before finally getting that next blast off to the upside.
What's the next big move for gold? So I think it's the easiest if it goes down towards 3,000 first, then goes up towards 5,000 first. Why? Because to me, long-term, gold is a store of value, place you're supposed to invest in stuff and buy things. But if it goes to 5,000 first, I think it's going to just do what it did following this peak in 1980 and its peak in 2011. Just get stuck in a range for a while and get people suckered and getting longs at the wrong levels. But if we can get down to good support, most long-term moving average is around 3,000 and around 30 in silver.
Gold has officially completed a massive technical breakout from a long-standing wedge formation, unlocking powerful bullish momentum across the precious metals market. Historical chart patterns confirm that such tight consolidations typically trigger explosive, multi-day price surges before hitting major overhead resistance levels. Renowned technical strategist Gareth Soloway and senior commodity analyst Mike McGlone offer deep structural insights into these rapidly shifting macro cycles and technical setups. Gareth Soloway underscores that gold is primed to extend its immediate rally toward the critical $4,375 price barrier in the near term. While temporary pullbacks down toward foundational support lines remain possible, the broader multi-year trajectory signals extraordinary upside potential for precious metals investors. Driven by relentless money supply expansion, currency debasement, and compounding global debt, historical market cycles are compressing rapidly. Proprietary quantitative forecasting calculators project that gold could skyrocket to a staggering $13,000 per ounce between 2029 and 2031, marking a historic secular bull market. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Gold today, look at this. You know we've been looking at this wedge pattern for quite some time. Notice how when it finally broke, it was explosive. That is very normal. When wedges come to a head like this, you know that it's building more and more energy, that when it finally breaks free, it's going to have a significant surge. I actually think this could be a multi-day move to the upside on gold, possibly as high as this area. Now, why am I choosing this 4350, 4360 level? Well, the reason is you have basically this area right here, right? So again, we essentially have this pivot low, this area here, we wicked below it or tailed below it, but really the body's held right there. Then you also touched it right here. Then you broke below it, but then retraced into it. So it's already established itself as being a significant resistance point, or technically support point back here, but now resistance. Therefore, if we rally up into this, and this would be around 43.75, it makes sense price could see a little bit of a pullback. But at this point, as long as this zone holds to the downside, then you likely have viable pullbacks, okay? Now, does it mean that my 36 to 3,500 level, which was my most bearish case where I would be loading the physical metal buy, is off the table? It doesn't, mainly because I think, again, we can still see these lines slope down, and if we do a retrace, we could get to them. But we talked about this when we got below 4,000, is that once you get below 4,000, you're within essentially what they call government work. You know, it's close enough for government work to be considered into that level, especially with my upside target per the calculator that I developed that you have access to on Verified Investing, that shows that by 2029 to 2031, gold should be at $13,000 per ounce. So that's significant upside here on the charts. Now, let's go back to the chart and take a look. So we notice this wedge pattern, right? The question is, in history, we know that the cycles are speeding up on gold. I think that has a lot to do with fiat being printed. Remember, every year right now, fiat is increasing. Money supply is increasing by 7%. In addition, the US debt, global debt, is increasing exponentially over years and years. And so the cycles on gold are compressing, which is part of the reason why the next big top will occur within just a few years from now, between 2029 and 2031. But also, mainly, again, it just tells us that when we look back at history, we want to look back and assume that it took longer back then, but the formations should still be accurate. So what we do here is we say, all right, so we have this wedge pattern, and then we got a breakout. What happened historically? And so what we're going to do is we're going to go back. We'll go again all the way back to the 1980 peak on gold. And the reason I'm bringing this up is I want to look at the structure, and the structure is very, very similar here. So here's our peak in 1980, and we can take a trend line and essentially run it down here, right, where we have this scenario right there, right? So essentially what we have is a situation where you have a trend line down sloping. We could even argue that maybe it should be here. Either way, I actually like this one quite a bit more because you pierced it here with the wick, but you never closed above. So high pivot, right? High pivot. And then here we just kind of hugged the line until we broke out. And then we kind of did this little kind of hug the downslope, making new lows before the bottom was essentially in on gold. And so the question is this formation valid? And that's up for debate. But my strong case is that human nature doesn't change. So were the factors back then different? Yes. But was fear and greed the same back then? And so, and this is, by the way, this is how we were watching for this wedge pattern breakout as well, is looking back historically. And what we can see here is you also have a secondary pivot point right through here, right? So if we look at this, you can see how we have this same sort of wedge formation, which is the same as we were just looking at in the current sphere of the chart on the daily chart, right? And so you can see here we had a breakout, little bit of an up move. Then it kind of came back in and settled in, but held this line before a bigger up move came in. So if we go back to our current time frame and we flip over, what this would be is this is that same breakout. And again, like I said, I think it could extend itself a little bit, and then we could come back in and potentially find our way back down into this level before finally getting that next blast off to the upside. So just keep an eye on that. Either way, this is a breakout on gold. The wedge pattern has broken. In other words, the technical chart has spoken. So it's a breakout. Now the question is, where does it go in the near term? Longer term, the breakout's clear. It's going up. It's going up, right? Near term, the question is, do we retrace back in or do we just continue to move up? Like I said, I think we can get to about 43.75. Then we would want to see what type of pullback we get. Do we get a bull flag? Do we get a bigger retrace? All of those factors.
Precious metals and speculative risk assets face severe macroeconomic headwinds despite recent price surges. The broader financial landscape currently displays critical valuation warning signs, with stock market capitalization to debt ratios hitting extreme levels last seen in 2007 and market valuations matching historical 1928 peaks. Analyzing near-term price predictions, the most logical technical trajectory for gold involves a preliminary drop toward $3,000 to retest major long-term moving averages before attempting any sustained rally toward $5,000. Surging directly to $5,000 risks trapping investors inside a multi-year sideways range similar to previous secular market tops. Furthermore, leading risk indicators like Bitcoin have already rolled over, signaling impending market volatility. If stock markets undergo a sharp corrective decline, gold and silver will likely experience synchronized downward pressure. Now, let's get back to the interview.
The best year in history, Kai, in gold was last year in a disinflationary environment. That was a pretty good sign of a peak. I mean, you're supposed to just say, thank you, that's awesome. Now we're in the hangover stage. The question, how long that lasts? What's the next source of alpha to the stock market? And to me, that's where I've been putting the two dates in my headlines, 2008 and 1929. Like I mentioned, we have the highest stock market cap to debt since 2007, the highest bond yield since 2007, and we have the highest market cap, the Buffett model, on a year-end basis since 1928. So maybe those things won't happen, but then we'll have other things that are really starting to worry you. My leading indicator for all risk assets was Bitcoin, and that's rolled over. And then I look at some of the facts. 100-day correlation between copper and the S&P 500 is the highest ever. It's like 0.6 in a rising market. Almost always these things go downwards. So you see the problem there, and you look at the volatility in the S&P of gold versus S&P 500. Gold is running 2 times on an annual basis versus the S&P 500. That's not a store of value. So what I'm trying to do on my writing and on your shows, I have to bring out things your average person does not hear from your other guests and when they hear on TV and the news. And those are some of the significant things I'm looking at as warnings. Remember, it's August. We have to look forward to volatility season, and absolutely positively my view is on all the metals from gold to copper, for them to keep going up, stock market has to keep going up. Now, you're seeing today, you made a good point. We've seen crude oil going down. That means bond yields are dropping a little bit. That means the cost of alternative cost of holding a non-income producing asset like gold is improving, and silver's up a little bit too. But they're bouncing within, I think, our markets that have rolled over to bear markets. Gold's well below its 200-day moving average. It's rolled over. That's about 4,500. Silver's well below its 200-day moving average. Bitcoin's 200-day moving average is rolled over. And so let's look through the end of the year. What matters is the stock market absolutely has to go up for these to go up. And that's where copper is the one that matters the most in metals. It's got to go up, because if it goes down, the dominoes tumble. They came to good levels. First, gold at 4,000 is a perfect level to hang out. I mean, it's ideal. It's round number. Gold loves round numbers. It's just the way it's always worked. It bumped up against 2,000 in 2020, 21, 22, and 23. Those were 4 years of outflows in ETFs. And that's when I got so bullish. I stayed bullish and finally broke out in 2025. But no, it's a good place to hang out. But the thing is, what's the next big move for gold? So I think it's easiest if it goes down towards 3,000 first, then goes up towards 5,000 first. Why? Because to me, long-term, gold is a store of value, place you're supposed to invest in stuff and buy things. But if it goes to 5,000 first, I think it's going to just do what it did following this peak in 1980 and its peak in 2011. Just get stuck in a range for a while and get people suckered and getting longs at the wrong levels. But if we can get down to good support, most long-term moving averages around 3,000 and around 30 in silver. If we can get down to those levels first, re-enter longs. McGlone can get bullish again, but I'm certainly not. I can't do it here. It's just we got to see what happens, and that's why my next thing to do is keep reiterating what my focus for this year is. Volatility should pick up in the stock market. It's picked up a little bit. The market keeps going up, and it should benefit things like treasury bonds. That's been completely wrong. But my key theme has been to sell some of the primary risk assets that went up too much: silver, gold, Bitcoin, and copper. Copper is the number one I've been wrong on, and that's what I want to show you in a little bit when we get a chance to point out what I think is going on, what's going to happen with copper. Only thing I did this year was sell some precious metals and buy some bonds. That's it. Nothing since. But I'm under compliance. The key thing is compliance has never said I can't say overweight treasuries, and I keep saying it because they didn't say that. And so the question is how far you move out in the curve. So absolutely admitted, been wrong so far this year, but my key theme is the stock market has to go down for that trade to kick in. As we speak, the S&P 500 total return on the year is 13.5%. And the treasury total long bond is down about, as we see, the 20 years down about 3%. Okay, you know, if you're depending on how much leverage you're using, but Bitcoin's down a third, gold's down 5%, silver's down 16%. And here's the key thing I like to point out: the Bloomberg All Metals Total Return Index. That's my favorite index in commodities. I asked the index team to create it 10 years ago because in commodities, if you're going to invest in anything, physical commodity, stick with metals. It was up 22% in a year. Now it's only unchanged at 1%. You have to ask yourself, what's going to make that recover and go higher? Number one theme, I think, is stock market has to go up because there's a very high correlation. So I'm not, the thing about, when you buy treasuries is, yeah, okay, it depends on, so the world I came from was leverage. It depends how much leverage you use. And I just, as an investor, I think this might be a year to hide. And so far, I've been right on hiding in precious metals, hiding away from and running away from things like those and cryptos and Bitcoin. But so far, the only game left in town is the stock market. And that's part of the reason gold has a headwind, because why mess with a rock when the stock market's taking off so much? And I want to show you that one chart on metals I took a second to bring up if I can. I'm just going to share it real quick. And that is the key theme. So gold is beta to metals. And it is, it's the number one that matters in the metals sector. And the key theme is I mentioned the Bloomberg All Metals Total Return Index. This is what it's done so far. Metals have been dropping since 2011 or so, right about when stocks bottom, metals have been dropping versus the stock market since then, and it's just a complete dud versus the stock market. Yet metals trade on higher volatility. Gold right now is, like I said, this volatility typically used to be lower than this S&P 500. Now it's higher on an annual basis. Copper's volatility is about 2 times S&P 500. That's very rare, but that's the key thing I'm worried about. We've been plunging versus the stock market. We just bumped up to that key peak early in the year, and now we're rolling over. What's going to make metals recover versus beta, versus S&P 500 total return? And I show you that here. S&P 500 divided by GDP, that's got to go down, which means everything goes down. But see this, I mean, metals might recover a little bit, but here's a key theme I like to point out in things like copper. Managed money net position in copper, i.e. futures, have been overweight long. Right now it's only about 25%. They're up with 30%. That's the CME contract for reasons. It's political. It's Trump. But they've been overweight this contract for about 2 years, yet since 2023, it's way underperformed the S&P 500. That's what I show you here in copper, underperformed the S&P 500. And it trades at a much higher volatility. So I look at it as a former risk manager at S&P, at a hedge fund, and a former hedge fund trader. If I got a trader who's been long this asset for 2 years, depending on what he has next behind it, is as a hedge fund, you're supposed to be outperforming the stock market. And I'd have to say, well, I'm glad you're doing well, but you are making less money than beta, which is what everybody goes to, and you're trading at much higher volatility. What's good about that? So that's the key theme I need to bring out in these conversations, that everybody points out all the fundamentals of electrification, all that decarbonization. You can get that in a typical Google query. This is the things people have to worry about, and this is why I point out managed money net positions are pretty long. If they stay long, that's great, but all you need is a little flush in that, and you might get a chance to buy copper around 5. The key thing is copper goes down, it takes the stock market with it because it's highly correlated. And what does that mean for metals? For all metals, it'll probably go down. That's where I think this is just a major, significant risk wall of worry that I don't want to join.
Intermarket dynamics between equity indices, industrial commodities, and precious metals highlight expanding downside vulnerabilities across global financial markets. An unprecedented high correlation between copper and equity benchmarks represents a massive wall of worry, particularly as base metals display double the annual volatility of stocks while severely underperforming benchmark returns. Institutional positioning reveals that managed money holds heavily concentrated long positions in futures contracts, leaving industrial commodities exceptionally vulnerable to sudden liquidation flushes. Technical predictions indicate that if copper prices experience a severe breakdown, it will drag equity markets downward, triggering a destructive domino effect throughout the entire metals sector. In such a major deleveraging event, gold, silver, and copper will likely suffer synchronized price pullbacks, eventually creating high-probability long re-entry opportunities around key support zones like $5 for copper. Meanwhile, broader commodity indices reflect stagnant performance relative to equities over multi-year horizons. Capital flows are predicted to rotate heavily into defensive assets like treasury bonds as seasonal market volatility intensifies. Portfolio managers must prioritize capital preservation over chasing overextended asset rallies, as persistent macroeconomic imbalances threaten speculative commodity valuations worldwide. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.